Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Dan Lewkowicz. Dan is a seasoned real estate veteran with over 15 years of experience in many facets of the real estate industry. Starting his career in house hacking, he quickly moved to house flips around the metro of Detroit and eventually created a company called Renaissance Real Estate Ventures. Currently, Dan is Director of Investment Sales at Encore Real Estate Investment Services and specializes in shopping centers, medical office buildings, industrial fulfillment centers, quick service restaurants, and automotive repair parts stores. So Dan is an expert broker. I mean, he works mostly in the triple net space. So if you are looking at any of those kinds of assets, this is going to be a great show for you. Even if you're focused on multifamily, I think you're going to learn a lot. He brought up some things about some red flags about triple net leases that I don't believe we've heard before, which were it was so crucial if you're getting into this space. And so even how he determines properties, what property's worth, and how he explains that to a seller, how he comes up with that. And know if you are in real estate or growing your commercial real estate business, especially if you're looking for commercial net properties, triple net properties, you are going to enjoy this show. All right, Dan, welcome to the show. Dan, give us a little more of your background or tell us a little bit about how you got into this industry, and then we're going to jump into your unique ability that's going to help the listeners.
Sure. So I'm a commercial real estate investment sales broker, which means that I broker transactions that involve the real property that's typically leased to major national tenants like Walgreens, CVS, Starbucks, McDonald's, Wendy's, things like that. We also sell a lot of strip centers, shopping centers, a lot of industrial product like FedEx grounds or Amazon fulfillment centers, tire stores, pretty much any type of commercial real estate that's leased to a national tenant, whether that be a single tenant or multi-tenant. I myself got my start in the real estate industry about 15 years ago. I helped to create a company called Disability Made Easy, which was a barrier-free home modification company. I was in charge of the sales and marketing, but that's really where I got my first taste of property renovation, because I used to go out with our project manager and see these, functionally obsolete homes that were not serving their occupants whatsoever. Our business was designed to modify homes to make them handicap accessible. So I remember going out and never forget this the first time and seeing this property, thinking to myself that there's nothing that can be done here. This thing needs to be torn down. And then watching our project manager sketch out with his pen and paper and graph, a way to turn something that was functionally obsolete into something that was useful and beautiful for that particular owner really, stuck in my head. And that really was something that motivated me when it was time for me to buy my first home. I decided I could buy a home that was ready to go or buy something from the bank, and it was the middle of the recession. I ended up doing the latter of the two and, really got my feet wet in terms of purchasing homes, renovating them and reselling them. And that was always like a hobby of mine, something I did on the side. I've got experience as a sales, running a sales team for a title insurance agency and as a business development executive at Amazon. And it wasn't until around 2016 that I actually jumped off on my own and went full-time in real estate investing, in purchase, renovation, and resale of properties in and around Metro Detroit. And then through that process, I found myself, really getting into my calling and my passion as a commercial real estate broker.
Nice. I was going to ask you earlier, you were talking about being a broker. I was going to say, is this something that you've dreamed of since you were 5 years old? Most it's usually most of us, it's like, we got there by this winding course,
Yeah, absolutely. And I would say I think that earlier on, I kind of fell in love with this idea of house flipping from, just like kind of a philosophical perspective, maybe not practical. And after doing it for such a long time, I still love it. I tell people, I joke, I say I'm a recovering house flipper. I still have that itch that I always want to scratch, but I really never thought about brokerage. I think people's general conception is that, an agent is someone who sells homes and runs around and does this and does that. But really what I do as a commercial real estate broker is very different. And frankly, it's something that I really didn't know anything about until I, first started in the profession.
Okay. So now, what's your, like today, what's your focus asset class? What's your focus? Who's your focus client? Sure. Your Yeah, who is that?
So today, my focus really is on quick service restaurant. I just sold another Wendy's property today. I focus on shopping centers, on automotive repair stores, and also on medical office buildings. Do a variety of other types of asset classes, but that's what I would say is the most popular for me personally. And my clients range anywhere from a one unit, a small quote unquote mom and pop investor who owns maybe one or two buildings, all the way up to publicly traded real estate investment trusts that are placing $1 billion or more dollars worth of assets every year.
And so, one thing that I know you mentioned before we got started that you're really good at is helping owners know what their property's worth, right?
Yep.
And that can be difficult, I think, to a lot of us to, well, what is it worth? How do I even, where do I even start to figure out what my property's worth? And I would imagine if somebody's owned it for, 10 years or longer, they probably don't know exactly what it could be worth right today. But why don't you just shine some light on that? How do you find these, let's say, owners? How do you connect with them, and then kind of walk us through that process a little bit of determining the value of a property like that?
Sure. So typically it's one of two ways. It's either direct outreach that I do myself, or more than likely, believe it or not, it's actually leveraging things like social media. Email drip campaigns, speaking on podcasts. I have my own show about commercial real estate so that I can kind of turn the tables. And instead of just that one-to-one interaction, it's me putting myself out there and then investors reaching out and saying, hey, Dan, saw you on, such and such show. I've got, this portfolio or this property and I need to know what it's worth. Oftentimes what I do is I'll have my team reach out to property owners who own assets that are either the same or very similar to a property that I just sold. So, we'll send out an email with a few flyers saying, hey, just sold these 3 Wendy's properties. I know you own a Wendy's property. I'd love to let you know what it's worth, right? Because there's no one better suited to tell you what a property is worth than someone who just sold a bunch of them, right? So, your question is a really good question in terms of how we put together our valuations. And you bring up a good point, right? Someone who owns property for quite some time, they may not know what it's worth. And in fact, in today's market, even if you thought you knew what it was worth 6 months ago, it's probably not worth the same today. So really that process is a complicated process. And that's why you need to be working with, a skilled broker such as myself. But really, in a nutshell, the process boils down to kind of an art and a science that revolves around the following variables. So number one is going to be lease term. So how much term is left on a lease, right? So if there's 15 years left on the lease, the property is going to be worth significantly more than if there's 15 months left on the lease. The next variable is going to be rental escalations. Typically in our line of work, the properties have annual or otherwise, scheduled rental escalations to hedge against inflation. The next variable is going to be the tenant, right? Are we talking about a Wendy's franchisee that has 3 stores? Or are we talking about Meritage Hospitality Group that has 344 stores? So how strong is that guarantee? The next variable that we're going to look at is the demographics. Now, demographics include the traffic counts on the street, right? The visibility. They include things like average household income, population density, different trends in terms of, is the population growing? Is the population, shrinking? And then there are other variables as well. If you're dealing with specific asset classes like quick service restaurant or maybe automotive, repair stores, we're going to look at things like the sales and the rent to sales ratio, right? We want to make sure that that's a healthy operation. So typically, for example, in the quick service restaurant space, we like to look at rent to sales figures that are below 8.5%. And the further we can get them below 8.5%, the stronger the asset, because chances are that operator will keep that store up and running. So those are, a few of the variables that we look into. Again, lease term, rental escalations, demographics, guarantor strength, and then other variables about the actual operation itself, such as the sales.
Why no multifamily?
Why don't I do multifamily?
Yeah.
Yeah. So, I previously did a lot of single and multifamily deals. Most of the multifamily that I would underwrite, I would, hand off to colleagues who would put them into syndications. I think it's a great space, but personally, if you're asking me from a brokerage perspective versus from an investor perspective, maybe I'd give you different answers. But just in general, I mean, if you look at the net lease space that I operate in, it's as passive as it gets, right? It's as stable as it gets. and it's as guaranteed and understood as it gets. So when a lease is signed, we know every single term of that lease for the next 15 or 20 years. We know exactly what the rental escalations are. And furthermore, we don't have any unexpected expenses, right? The actual income that's stated in the lease is the income, because the tenant in an absolute triple net lease, the tenant actually pays for the taxes, the insurance, the common area maintenance, roof, structure, parking, snowplow management, everything. Whatever expenses there are, that's paid by the tenant. And you as the investor have the absolute certainty of knowing this is the exact dollar and cents check or ACH into your account that you're going to get every single month. And further, to be honest with you, with what's gone on these last few years in the multifamily space, I mean, we've seen cap rates compress nationwide. I have clients that are trading into or trading out of multifamily and in and out of net lease. And when I see cap rates that are similar or lower in multifamily, where there can be a lot of unknowns and it's not as passive as they are in net lease, I say, why wouldn't you go with the stability and the security and that longevity and you know that the net lease investment vehicle provides?
Now, I had to ask. I know there's a lot of multifamily operators or investors that are listening too. I just thought it was interesting.
Sure.
But I think that's a great list. Just those 5 things even that you mentioned there when we're thinking about what is a property worth. We do have to consider all those things. What's going to be probably one of the biggest things that's going to fluctuate the value the most?
Well, that would definitely be, it's a hard question to answer actually, but I would say in general, it would be lease term. If I have, an Apple again, and it's funny because you drive down the street and you say, okay, that's a Wendy's and that's a Wendy's, so they got to be worth the same or they have to be analyzed the same. But the truth is, based on the variables I told you, that's definitely not the case. If everything was equal in the lease, right, but one had a 19 or 20-year lease and one had a 1-year lease, I mean, you could see a difference of maybe 200 basis points or 2% in terms of the annual yield. So that would be very important. I would say probably the next most important variable would be the guarantor strength. So if one Wendy's was operated by a 3-unit operator and one was operated either as a corporate store or a 300-unit operator, you'd also see a very large spread. Not the same, not 200 basis points, but maybe 50, 75, or 100 basis points. So those are going to be the strongest variables. And it's important for investors to recognize that you're buying for cash flow and not appreciation. So the longer that you own that property and the more time is burned off the lease, the cap rate will actually go up and the value will go down. However, at the end of the lease term, there's a lot of creative ideas that people can do, such as we can talk about a little bit, but it's called a blend and extend, where the owner actually strikes a deal with the tenant to, believe it or not, lower the rent, right? Which you would think is counterintuitive, right? Because lowering the rent, that's your net operating income. But in exchange for the lowering of the rent, they extend the lease, the blend and extend. And that can have tremendous impact on the cap rate, like I just mentioned to you.
Interesting. Blend and extend. So by extending that lease, we're increasing the value of the property that much more, which makes it that much more lucrative to sell, maybe sooner than you expected.
Yes, exactly. That's right.
Okay. No, that's so interesting. Just thinking about questions the listeners may have. What are some common questions that you get maybe from a seller when they're considering, like, is this the right time? Maybe it's, should I wait 6 more months? Or, how do you determine some of that or guide that seller in that thought?
Yeah. So, I always lead with the value proposition. My job here is to provide value. I'm here to tell you what your property is worth. If it's a good decision for you to sell, I'm here to assist you in the sale, right? One of the most difficult questions that an owner deals with, my phone's blowing up right now dealing with a client with this exact situation is, well, hey, I've got this asset. I want to sell it for whatever reason. And there's a lot of reasons why people would want to sell it. Maybe there's disease, death, divorce. Maybe they're splitting up a trust. Maybe they just want to cash out of this property. They want to be closer to home. But in the vast majority of cases, when someone sells a net lease property, they do a 1031 exchange into another property. So one of the difficult hurdles is, well, if I sell this property, right, I have to find something that's giving me a better return. It's that age-old issue that we face in residential real estate as well, right? Like, I'm looking to sell my house that I'm in now. It's top of the market, but of course I have to replace that house, right? And I'm going to replace it top of the market. So really the challenges are making sure to find a replacement asset that suits the investor as well as possible.
Yeah, that's difficult. No doubt about it. We deal with that with investors often. It's it's a difficult issue to be in, but we want to try to do it the best we can if we can do a 1031. Thinking about that, the buyers though that are looking at triple net, I just wonder, like, how many triple net buyers are also doing multifamily, or is it most of the time do you see people that are just like strictly triple net?
It's a good question. I would say the majority of my clients have the majority of their portfolio as triple net. I mean, I think that today we're seeing a lot of multifamily owners who are transitioning into triple net for the reasons that we just discussed. But I think in general, when people experience that passivity and that stability and guarantee of income, they really find that, it's a space that they're very comfortable in. And there's a lot of diversification you can do within the net lease space. So I find that most of my clients have most of their real estate portfolio in net lease.
Dan, I'm maybe there's listeners right now who even own some multifamily or have been very focused on multifamily, and they can't maybe find a deal right now. And they're thinking, okay, Dan, you've got my ears, perked up here, and I'm thinking about this triple net stuff. I mean, trying to, what's the best way you can think of for them to like learn this industry, for them to be able to say, be confident moving forward in some kind of triple net opportunity versus multifamily?
So, you're definitely going to have to, I would say, reach out to a good broker to get that education, but be honest with them, be transparent with them, tell them, hey, I'm looking to learn. Maybe I'm not yet ready to pull the trigger. I want some education. At the same time, there are good resources out there for, learning about commercial real estate investing. I personally have just released a course called the CRE Pro course, which is, you can locate it at www.creprocourse.com. That's creprocourse.com. We were just featured last week in Yahoo News, Yahoo Finance, Associated Press, Market Watch, Seeking Alpha. About 250 plus different media outlets picked us up. That's a great course. It's designed specifically for people who want to get into commercial real estate brokerage. However, I always tell people, and we have a lot of investors that have registered for the course because they say, even though I don't want to become a broker, I want to know how to think like a broker. And really, we're pleased to have seen that a lot of our participants are leveraging the information that they learn in the course to be, better investors.
Nice. On that note too, just for somebody that's getting started, some red flags maybe that of for someone getting into triple net, they're looking at deals. What are some uncommon things that are typically missed by maybe the newer buyer?
Yeah, sure. I mean, and these are things I've seen from, during my career over and over again, unfortunately, with people who purchased property, years ago, and then they're coming to me and they want to sell it. So one of them is what's called a co-tenancy clause. And what that means is, let's say you've got a shopping center, right, that has, I'm just going to throw out some major names because people know them. Let's say it's got a Walmart or a Home Depot or a Lowe's in it. And now, the property in question is a PetSmart. Perfect example. I had this exact situation a couple of years ago. So there's a co-tenancy clause that says that if the major anchor, so that Walmart or Lowe's or Home Depot, if they vacate, then automatically PetSmart is able to decrease their rent by 50%. So we call that a wrinkle in the lease, right? Almost as if there was a wrinkle in the lease that somebody didn't, was folded over and somebody didn't notice that. So unfortunately, this individual investor, and he owned 15 properties like this, but he didn't realize when he bought it, and his broker didn't really, provide him with great service. He didn't realize that there was that co-tenancy clause. So keep in mind something like that. Let's say, again, comparing apples to apples, if I had another PetSmart that was exactly the same in every way, theoretically, that the fact that this one has a co-tenancy clause and another one doesn't is important, right? It definitely decreases the value. So that's definitely one thing to keep in mind. Another, and this is fascinating, is again, back to the Wendy's example. I've got a Wendy's I'm dealing with literally today that has a clause in it. And this lease was written 15 years ago. So forget about COVID, but think about the implication today. So the lease has a rent abatement clause that states that if there is a government or state shutdown that prevents the tenant from utilizing their dining room, they can pay 60% of the typical rent. So obviously that's what's gone on here in Michigan with this particular property. And believe it or not, the tenant was doing better, right? They're operating out of their drive-through. Their EBITDA went down, their expenses went down, their sales went up, but they were paying this owner only 60% of his typical rent. So compare that with another Wendy's lease that I have another property I sold about a week or two ago, another Wendy's property, and it has a rent abatement clause that says under no circumstances whatsoever will rent ever be abated, right? So obviously, compare apples to apples. The property with that bulletproof clause that says no rent abatement compared to that other one that says 40% knocked off if the dining room is shut down, that's going to impact the value of the property. So those are just a couple examples of things that, people need to keep in mind. I think also it's very important to recognize the strength of the actual tenant and the likelihood of them extending the lease, right? So if you're dealing with shorter term leases, it's important to know how the tenant is performing to prepare and conduct an analysis to see what the likelihood is of them extending. Because traditionally, you're going to get a higher return, right? A higher cap rate for those shorter term leases. But you have to be able to mitigate that risk, because the last thing that you want is an empty box, right? That you need to now re-tenant.
Wow, that's 2 points that all of us should be taking note of. No doubt about it. Co-tenancy clause and rent abatement. Yeah, you said that one was signed like 20 years ago or 15 years ago.
Yeah.
And now look,
yeah.
Wow, it came into effect now in a big way. And maybe that gets you a better tenant if you have some clause in there. But man, selling that, I can imagine why that would be a nightmare.
Yes.
What about you're working with lots of buyers and sellers, and even thinking about this last year, what's happened, or I guess, what's happened over this last year. How do you like to see, a buyer say prepared for some kind of downturn like this outside of, that rent abatement clause? How do you like to see them prepared for something like that? Or when we're talking about triple net specifically, I mean, how could somebody have been prepared for something like that happened last year? Let's say they had a Wendy's or some kind of restaurant or triple net.
Yeah. So overwhelmingly, these assets performed incredibly well during COVID, especially the single tenant net leased assets that were, so to speak, these essential retailers, right? Anything with a drive-through, fast food, pharmacies, dollar stores, automotive repair places, things like that. Believe it or not, the cap rates actually went down on those properties. They actually became more valuable. So really, the investors did quite well during this pandemic. And I mean, we're setting records right now, selling property at all-time low cap rates, all-time high price points. So that's specifically in the single tenant space. Now, if you kind of shift over to multi-tenant or shopping centers, that's something that I specialize in. And I was selling a lot of those right before, up until the pandemic. In fact, I had a shopping center deal that literally closed March 31st of 2020, which was within days of when the governor here in Michigan shut down the state. And out of 7 tenants in that strip center, when that property closed, all 7 of them were closed for business. So if we want to kind of shift gears and talk about multi-tenant retail, it's very important to have a diversified rent roll, right? It's important to have diversified tenants that are in different industries, so that if one industry gets hit, you don't take a huge hit across the board, right? That's number one. Number two, you also want to focus on what we call diversified lease rollover, which means you don't want to see a shopping center where 10 out of 10 tenants or 9 or 8 out of 10 tenants have their leases rolling over in the same year. I always like to look at the rent roll and see, okay, this tenant is rolling over in 3 years, this one in 5 years, this one in 6 years, this one in 7 years, because it's so much easier to fill one vacancy than it is to fill multiple vacancies for a variety of reasons. It's more work. And also the center appears so much more vibrant and healthy when it's got high occupancy, right? If you have a lot of tenants vacating at once, all of a sudden new tenants are kind of scratching their heads saying, wait a minute, is this really where I want to be? So that was a challenge in COVID. And what's interesting is now we're starting to see, 14, 15 months later, we're starting to see a rollover where those assets where, those multi-tenant properties that maybe were more mom and pop, tenants, whereas they struggled during COVID, now they're really starting to turn back around, and that market is opening up, because for the better part of a year and a half, most of our industry focused on these essential retailers, and only now are they starting to really open up the doors and focus back on the multi-tenant space.
Dan, do you have any predictions in the real estate market over the next 6 to 12 months?
Oh man, I mean, I think that, the way I look at it is that interest rates, although the 10-year treasury has gone up significantly since the bottom, and believe it or not, this is the fastest increase in the 10-year treasury in recorded history. However, it's still at historic lows, right around where it was, pre-pandemic. So I think the fact that the Fed is keeping interest rates low, and the fact that we've printed, $10 trillion worth of money and have really stimulated not only businesses, but private individuals and spenders, and keeping this economy going strong. I think that those variables will lead to stability in our industry, both in the residential real estate space and the commercial real estate space. Okay. What I will tell you though, is that there are two issues that are coming up that could significantly shake things up. And that's the potential either obliteration or abolishment or potential change in the 1031, as well as the change of capital gains taxes, short-term capital gains taxes turning into ordinary income tax. Now, just to put it in perspective, we sell about $750 to $800 million of net leased assets a year, and approximately 37% of those transactions are related to 1031 exchanges. So if the 1031 goes away, or if it's significantly limited, let's say to $500,000 of gain or $1 million worth of gain, we will see a repricing in the market, no question about it. Everything is going to get shaken up. What'll probably happen is, unless it's made retroactive, we'll have just a crazy year where everyone's going to try to 1031 one last time. And then at that point, I think that the floor will fall out, and then we'll have a repricing of the market. My hope is that that doesn't happen. And I urge anyone who's listening to this or viewing this to reach out to your legislators and speak your voice and make it heard, because the 1031 is an incredible vehicle that allows our economy to continuously grow and churn, and is a very commerce and small business friendly legislation. And I would hate for that to change or to be compromised.
Yeah, it will definitely shake things up in the real estate market, no doubt about it. And there's plenty of political figures who have made tons of money in real estate and by doing 1031 exchanges on both sides of the parties. In both parties, yes. Right? So they definitely, there's plenty that know the value in that. But yeah, we'll definitely have to see what happens there. Dan, what about any daily habits that you have that you are disciplined about that have helped you achieve success?
Well, I think one of them is with social media. I make sure that I post on LinkedIn every single day, no matter what. I think that that's been helpful to me. And then I think for me, it's important to have that balance. Travel is important for me. Leisure is important. Taking some time in nature, taking some time to myself or to play, guitar, things like that is really important. And then, I kind of function differently than most people. I start my day out pretty relaxed, pretty slow, probably later than most people. And then I get going, I stay in it, and I'm pretty much, in the zone until the evenings. And that's what works for me. I think that's important, is to make sure that, you choose a style that works for you. And then, I've always found that just taking action and massive action is what is a key to success, because most of what we do is a numbers game, right? And really we can only control the input. So I find that activity is what's most important in, seeing success. And then what also really is great for me is I try to live my life with the motto of, provide value and everything else follows. So when I'm on a call with a potential client or with a client, my goal is to provide value to them, which means I'm not trying to sell them on anything. I'm trying to provide value. And I believe that all the results follow from that, it's really liberating, because my focus is not really on my end results. Sure, I have my goals in mind and I've set my mind to what I want to achieve, but my real focus is on providing value to my clients. And that allows me to have that freedom of not focusing only on an end result or only on a dollar amount.
What is the number one thing that's contributed to your success?
Oh, that's a good question. I would just say it's probably just what I call stick-to-itiveness, just to keep going. I mean, if I sat here and told you that I've always had success, I'd be lying. I mean, there were times when everything hit the fan and I didn't know what I was going to do with myself. But I mean, one thing I did know was that I was just going to keep on trucking. And, I think for me, especially like when the pandemic hit, I was talking to tons of brokers, and there was a general sentiment, I think, around the country of, this is going to destroy our industry. And I talked to so many people who said, Dan, I'm going to go into hibernation for next year. I'm going to write this year off. I'm not going to do anything until the dust settles. And when I heard that people were putting their feet on the brakes like that, I decided it was time for me to put both feet on the gas. And I think that really, helped me to catapult into what has now been my most successful time in my career, because I just decided that when other people were, pulling back, I was going to double down. And again, that goes with what I said before about, taking massive action. That just allowed me to really build momentum and to be, in the position that I'm at right now.
Tell us how you like to give back.
I like to give back by just trying to be a mentor to people. And, I personally love what I do. I think commercial real estate brokerage is the best thing in the world. I think real estate is an incredible industry, and I like to talk to young people and just kind of motivate them and get them excited about the industry and give them that knowledge, because, this is, whether it's as an investor or as a broker, I mean, where else can you literally have no education, right? No formal education, I should say, and be able to write your own paycheck and have financial freedom. So that's really, I think, the way that I give back, is to help other people get inspired and give them the training and resources for them to be successful on their own.
Nice. Well, Dan, it's been a pleasure to meet you. You're obviously an expert in your field, and I just think you've provided a ton of great value to the listeners and myself today, thinking through triple net properties, that asset class. We don't talk about that too often on the show. We should have some more people on, if at all possible, that are in that space, because it's not talked about, at least on our show, very often. But it is a great space to consider, right? Absolutely. And to have in our tool belt, no doubt about it, or to learn about. Dan, thanks again. Tell the listeners how they can get in touch with you and learn more about you.
Sure. So you can always go to, check me out on LinkedIn. First name is Dan, last name is Lewkowicz, Lewkowicz. Again, Lewkowicz. Also, I'll give out my cell phone. You can reach me if you have any property you want to discuss, or you just want to talk about real estate, or there's anything I can do to add value. It's 248-943-2838. Again, 248-943-2838. Happy to be a resource, happy to add value, and happy to discuss with anybody, who would like to.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.